I'm bored. Let's do something else.
Okay, let's play a game.
The only game I have is Monopoly, though.
Okay, that sounds fun.
Okay. Alright, you ready to play?
Yep.
Alright, let's do it. Okay, I'll go first. 9, not bad. 1, 2, 3, 4, 5, 6, 7, 8, 9.
One eternity later.
Dang it!
That'll be $2,000, please.
I don't even have that much money.
Well, you're gonna have to go bankrupt then. I'm sorry.
That's not fair. You scammed me. I don't want to play this game with you anymore. I'm going to sleep.
Whatever. You take all my money. Oh yeah. Oh yeah. That's what I'm talking about. Has this ever happened to you? After a few games in, and there seems to be a pattern to it, one player begins to consolidate all the assets. Now, if you're like me, you may think that you may have a chance to come back, but the reality is that the player that begins to consolidate all the assets in the game, such as cash, properties, houses, and hotels, usually ends up winning. So how does this happen? Well, simply put, it's a snowball effect. The more properties player 1 owns, then the higher likelihood that their opponent, player 2, lands on one and has to pay out rent. That rent payment can come in the form of cash, property, or it may just default and end up going bankrupt. Then player 1 absorbs all of player 2's assets and liabilities. The point of the game is that if you're in control of the lion's share of the capital and assets, then you have all the leverage. Now, believe it or not, this dynamic may be playing out on the geopolitical level with China and Africa. Now, I know what you're thinking. Just stick with me here. Take everything I just said and replace player 1 with China and player 2 with Africa. Then replace property with Chinese loans and rent with African debt repayments. So how did this start? During the 1980s, much of Africa was ridden with sovereign debt. By the next decade, much of the continent was iced out of the global financial system. Many programs attempted to fix this problem, but failed. It was not until 2005 when lenders decided to write off loans for heavily indebted poor countries and let them start off on a new foot. This program to write off loans was called the Heavily Indebted Poor Country, or HPIC initiative, by the International Monetary Fund. The HPIC initiative was launched in 1996 by the IMF and World Bank, with the aim of ensuring that no poor country faces a debt burden it cannot manage. Since then, the international financial community, including multilateral organizations and governments, have worked together to lower sustainable levels and external debt burdens of the most heavily indebted poor countries. And the HPIC initiative worked. By 2012, the median debt level in sub-Saharan Africa had fallen to just 30% of gross domestic product, or GDP. This is good because the IMF believes that a threshold for low-income countries is an external debt to GDP ratio of about 40%. Until Africa's debt problem finally subsided, the equivalent of when you finally stop lending on other people's properties and start racking up some of that cash in Monopoly. But wait, today, however, the median debt to GDP ratio in the region is back over 50%. Africa's debt to GDP ratio has been trending downward until it picked up in 2012, with an increase from 37% to 56% of GDP between 2012 and 2016. So what happened? Well, here's where our old buddy China comes in. China's pockets are flush with money from the unprecedented economic boom within the past 40 years as they moved away from Maoism and adopted free market economics. China, in fact, has been so successful that they skyrocketed to the largest economy measured by GDP based on purchasing power parity. So, a superior global economic positioning, state-backed financial institutions, and a balance sheet as strong as a Hulk hopped up on steroids, what did China do? Well, they started lending out money. Africa has become the fastest urbanizing continent in the world in the final frontier for the fourth industrial revolution. According to McKinsey, by 2025, more than 100 cities in Africa will contain over 1 million people. With this unprecedented growth, infrastructure improvement is a must for many African cities, much like any continent or country coming of age like Europe, United States, or China. Solid infrastructure is a platform that allows for that rise to a world power. This will become important later. But by 2017, the debt had racked up once again. Countries such as Ethiopia, Cameroon, Ghana, Kenya, Mauritania, and Zambia were up to their neck in debt. Additionally, Sudan, Angola, Kenya, Gabon, Mauritius had a collective GDP of more than 300 billion and debt to GDP ratios of above 60%. Keep in mind that a debt to GDP ratio of more than 40% is a huge red flag in the eyes of the IMF. However, presenting Africa as a continent ripe for debt exploitation fails to take the agency of African governments into account. African governments are voluntarily seeking out debt for a few reasons. The first one being the long decline in commodity prices since the global financial crisis in 2008. As proceeds from their main exports have fallen, so did their economic growth. African governments had to borrow more to fill the gaps in their budget. The second reason being high demand to boost infrastructure. The hope from this is that this will in turn improve the investment climate on the continent and facilitate economic growth. And the third reason is African debt has a relatively higher interest rate. Since this type of debt is high risk, it also means it is high reward. Other developing nations around the world have an interest rate of 4 to 5.5%, while African countries hover around 6%. All these factors led to an increase in debt on the continent. China helped finance all this new debt every step of the way with the help of a new global project. In 2013, Chinese President Xi Jinping announced a new global stimulus project to create a comprehensive infrastructure system ranging from China to Europe, involving 133 countries. This new project was called the Belt and Road Initiative. The Belt and Road Initiative had two aspects. The first being the Silk Route Economic Belt, which is an overland rail and pipeline connections between China and Europe via Western China and Central Asia. And the second one being the 21st Century Maritime Silk Road, which is a seaborne trade route linking China to Europe via South Asia and the Horn of Africa. Beijing says the project is a global economic stimulus package that would create economic growth for all countries involved. China pledged to finance and build all the infrastructure included in hopes to create a new economic corridor that stretches across Central Asia to Europe and the Indo-Pacific. However, in Washington, it's a little bit of a different story.
We don't drown our partners in sea of debt. We don't coerce or compromise your independence. The United States deals openly, fairly. We do not offer a constricting belt or a one-way road.
The U.S. argues China's version of Belt and Road fosters corruption. The state-owned China Communications Construction Company alone has been accused of bribery across 4 countries.
Westerners have coined the term debt trap diplomacy for what China is doing. Debt trap diplomacy is a claim that China deliberately seeks to entrap countries in a web of debt to secure some kind of strategic advantage or asset of some kind. The true motives of the Belt and Road Initiative are still unknown. Depending on who you talk to, is a godsend or a debt trap. At the April 2019 Belt and Road Forum for International Cooperation, former head of the IMF Christine Lagarde stated, "History has taught us that if not managed carefully, infrastructure investments can lead to a problematic increase in debt. I've said before that to be fully successful, the Belt and Road should only go where it is needed. I would add today that it should only go where it is sustainable in all aspects." Now, I am not definitively stating the true purpose of the Belt and Road Initiative, only time will tell. But the one thing we do know for certain is that the Belt and Road Initiative acted as a huge vector for Sino-African debt. So why is China behind the lion's share of the debt in Africa? For one, China does not have the shaky history with Africa that the West has. Slavery and colonialism still impacts current business and government decisions today. Secondly, China does not come off as a know-it-all. China approaches Africa like a partner, unlike the West. This means that China is not generally characterized as talking down to Africa, and it presents initiatives such as the Belt and Road Initiative as an equal partnership. So by 2015, nearly 2/3 of the new debt taken on by African countries was from Chinese loans. President Xi Jinping said, "Inadequate infrastructure is believed to be the biggest bottleneck to Africa's development." The push for Chinese finance infrastructure was backed by quotes like these from major Chinese figureheads. So, China began to replace traditional Western lenders as the region's largest creditor. In countries like Kenya, for example, China accounts for 66% of the country's bilateral debt. Chinese lending is driven by the financing of more than 3,000 infrastructure projects, through which China has lent more than 86 billion commercial loans to various African governments. So not only are Chinese earning profit from debt repayments, but they are also internationalizing their contractor services. Since 2011, China has been the biggest player in Africa's infrastructure boom, claiming 40% share of contractor projects, and that figure just continues to rise. Meanwhile, the shares of other players are falling, with Europe declining from 44% to 34%, and US falling from 24% to just 6.7%. The reality is that African contractors simply don't have the capacity for major development projects, which means if a large-scale infrastructure project needs to be completed, you either have two options: partner with a Western firm or a Chinese firm. And due to lax labor laws in China, they are able to undercut Western firms in prices every single time. But why is there this major shift to China? Well, the US depends on Africa for oil imports, but began to look internally to be less reliant on Africa for oil. The United States' decreased demand for African oil was a huge hit to Africa. This is where China came into the picture to be Africa's newest, largest trade partner. So not only does China own a lot of Africa's debt, but they are now their biggest trade partner as well. China sees a long-term political and economic promise from Africa. Not only that, over a third of China's oil comes from Africa, as well as 20% of the country's cotton. Africa owns half the world's stock in manganese, an essential ingredient for steel production, which is a major industry in China. Simply put, Africa is at the bottom of the S-curve. This is due to its abundance of natural resources, labor, and unprecedented growth within the next century. China recognizes this and is giving Africa the push it needs to get there, while along the way creating a sustainable political relationship. However, the topic of China's motive behind all this has been hotly debated, considering the debt that various African countries have taken on has been too much for some to handle. The $4 billion Addis Ababa-Djibouti railway cost Ethiopia a fourth of its 2016 budget. Nigeria had to renegotiate their deal with Chinese contractors because they fell behind on payments. And Kenya's new railway from Mombasa to Nairobi has gone 4 times over budget already. But what if countries can't make payments? Well, much like if you go bankrupt in Monopoly, the other players get to take your assets. For example, China took over Mombasa port in Kenya due to Kenya's inability to pay back its loans. This port is especially important because Mombasa is the largest trading port in all of East Africa. Additionally, Mombasa is projected to continue to grow into one of the largest and most important African cities within the next century. So not only does China own one of the biggest ports in Africa, that port is a heavily appreciating asset as well. Further, since China owns the port, they will be able to dictate trade between themselves and Kenya. This is not just happening on the continent of Africa, but other countries like Sri Lanka as well. China took over Sri Lanka's Hambantota port for 99 years after the country defaulted on its $1.1 billion in Chinese loans. Ecuador is forced to sell its oil on a huge discount due to its failure to repay its loans for a new dam. This is why American head of state such as John Bolton have said, China uses bribes, opaque agreements, and strategic use of debt to hold states in Africa captive to Beijing's wishes and demands. As long as China keeps on lending money to African nations, this cycle will continue, allowing China to capture more valuable real estate and increase their sphere of influence on the global scale. Allegedly. To Americans, this strategy is a new form of colonialism. To Chinese, this is a diplomatic mission in order to help poor nations develop economically. Will we ever find out if China is truly playing geopolitical monopoly? Well, only time will tell.